Hey, it's Tom here and welcome back to the channel. Now, just before we get into this video, I want to quickly mention that a couple of days ago, I got the chance to sit down and record a podcast episode with none other than Guy Spier, and a super investor that I've been following for several years now. It was incredible to get the chance to speak to Guy on a podcast episode, and that podcast will be going live probably within a day or two of you seeing this video on the Investing with Tom kind of main channel. So if you want to catch that podcast episode with Guy as soon as it goes live, the first link in the description will take you to the Investing with Tom podcast YouTube channel, sort of separate second YouTube channel. So be sure to head over to that one and subscribe to that channel if you're not already, and then you should see that episode with Guy as soon as it's released. There will also be a second link in the description which will take you to the audio only version of the podcast if you prefer iTunes or Spotify or Google Podcasts or whatever it is. That link will take you to each of those platforms to see previous episodes on the Investing with Tom podcast. So be sure to follow along or subscribe on whichever audio platform you prefer if you want to check out the podcast with Guy that way. And then, like I say, it should appear in your feed hopefully in the next couple of days. Okay, now back to the topic of this video, and this video is basically going to be a few case study investments about some of the stocks and businesses that Warren Buffett was purchasing into in the very early days of his career in the 1950s and 60s. And the reason I want to look at that time is really twofold. There's a couple of different quotes that you can pick up from Warren Buffett from various Berkshire Hathaway shareholder meetings or interviews that he's done over time. One of those quotes is something to the effect of, "A fat wallet is the enemy of superior returns." In other words, when you're working with smaller sums of money, which in Warren Buffett's world is talking millions of dollars rather than billions of dollars, when you're working with smaller sums of money, there are more opportunities. There is a larger investable universe, and for that reason, he was able to find some of these really interesting situations in the 1950s and 60s when he personally was working with smaller sums of money. And secondly, he has also said that if he were working with only $1 million today, he would be able to generate 50% per year returns. And I want to kind of understand, how he thinks he might do that. And again, the best returns of Warren Buffett's career were in the early days of his career. They weren't, when he was making his investments in Coca-Cola or Apple, that generated him and Berkshire Hathaway huge amounts of money and massive returns, but they really pale in comparison to his partnership days and even some of his Buffett partnership investments. So in this video, I want to share 2 or 3 of those particular investments from Warren Buffett. I'm also going to throw in one from Charlie Munger's partnership as well, and hopefully that will teach us a few lessons around the types of investments that Buffett and Munger were looking at that time to generate really, really high returns, and the opportunities that were available to them at that time, particularly when working with smaller sums of money. And a lot of the investment stories that I'm going to share in this video come from this book, The Snowball by Alice Schroeder, which is one of the big, fat, really comprehensive Warren Buffett biographies. I've marked out a few pages here. I haven't read the whole thing, but I'm kind of a few hundred pages into it now, and there's some really good investment stories, again, particularly from the early days that I want to share. So if you're wondering where this information came from, this is definitely a really solid book to check out on all things Warren Buffett. Okay, now the first investment that I want to cover in this video was in a company called Sanborn Map. Now, this is a company that Warren Buffett discovered in 1958, and it was a very large position that he put on in his investment partnerships at the time. He actually put about 1/3 of the entire partnership assets into the Sanborn Map situation. And the reason he had that big kind of chunk of money in Sanborn Map at the time was so that he could have a big enough stake in the company to basically get a seat on the board and make some changes internally in the business. Now, the situation at Sanborn Map was a classic early Buffett investment where it was basically very quantitatively cheap. At this time, he wasn't looking for the great businesses. He was really looking for things that were trading at a much cheaper price than the assets on the balance sheet of the company might suggest that you could perhaps liquidate the business for. And in the case of Sanborn Map, that looked a little like this. So you basically had a stock that was trading at about $45 per share. It was a kind of nice little business, but not a great business. And on the balance sheet of the company of Sanborn Map, you actually had an investment portfolio that on its own was worth about $65 per share. So you have a price of 45, you have an investment portfolio worth 65, and then you basically get all of the rest of the business for free on top of that. And Warren Buffett kind of swung big at that opportunity and made the investment. Now, there's a slightly longer version of that story where it sort of talks through the activist campaign that Warren Buffett had to go through. That's discussed in quite a bit of depth in the book The Snowball. But the kind of long story short is that Warren Buffett was really trying to accumulate all the shares he possibly could, to the point where he was asking his friends and family and other investors that he knew to kind of buy shares in Sanborn Map for him to be able to get him onto the board. And he really went through quite an extensive campaign with a very stubborn board in order to get them to kind of unlock the value that was in this investment portfolio. The board setup, it kind of seemed like a company that had been around for a very long time. The board was kind of just like an old boys club where, they turned up to board meetings to barely even talk about the business and, just smoke cigars and that sort of thing. And it was kind of a frustrating experience for Warren Buffett to actually get into that situation at Sanborn and try and convince them to do something. And in the end, he was able to get something across the line after a couple of fairly infuriating board meetings for Warren Buffett. And he was able to set up a situation basically where shareholders could exchange some of their stock in Sanborn Map for a portion of the investment portfolio so that they could directly get that value out of Sanborn and kind of capture that little arbitrage between the stock price and also the value of Sanborn's investment portfolio. Now, the second early Buffett investment that I want to talk about was in a company called National American. Now, National American has a couple of interesting aspects to it again. You might recall with the Sanborn example, we had a quantitatively cheap kind of opportunity, but we also had a lot of kind of footwork that Buffett had to do. He had to, buy a big enough position to get on the board. It wasn't a particularly kind of passive approach where he just bought a minority stake in the business and let existing management do their thing and that sort of thing. And there are similarities in this story as well with National American. Now, the situation with National American at the time, again, was very similar to Sanborn Map, where he first came across it because it was very quantitatively cheap. He found the stock was trading at $30 per share, and he found that the earnings of the company for the past 12 months were $29 per share. So it was more or less a PE of 1, and he felt that the earnings that were coming off of that business were relatively stable, and if he were able to accumulate a lot of shares at that price, he would basically get all of his money back within a year. It was one of, if not the cheapest stock that he had ever come across, and he basically started accumulating shares in the business. Now, one of the issues with National American in this example is that this was a stock that was very closely held by a lot of local farmers. Now, many of these farmers had actually originally paid about $100 per share for the stock, and a lot of them had kind of given up on this particular business. They didn't really have a full appreciation for how cheap it really had gotten. And there were a couple of kind of insiders in the company that were actually kind of going around to local farmers and offering them cash for their stock. And, this was stock that they'd been, again, sitting on for several years that they bought at $100. They basically considered it worthless because it had performed so poorly over time. And, when someone was kind of literally knocking on their door saying, here, I'll give you $30 for your stock, a lot of them were kind of happy to start handing that over. And Warren Buffett kind of hired some other people to basically go around some of these local farmers and do the same thing on his behalf. Now, one of the tricky parts was that firstly, it was really hard to get an actual shareholder register and figure out which kind of farmers in the region were still shareholders in the company. So he was doing some pretty intense scuttlebutt and finding very old publications from from 20 years earlier type thing of shareholder registries, and these stocks had been held very closely for a long period of time. So in many cases, when some of the people Buffett was working with would actually go and visit these farmers, many of them were still shareholders, and again, with some of them, when he was able to kind of turn up and offer them some cash for their stock, he was able to start accumulating some shares. Now, the other really interesting part of the story is that as Buffett was trying to accumulate some of these shares in a relatively tight-knit kind of farmer community, he really didn't want his name to be put into this situation, because he was starting to compete against, other people that were also trying to accumulate shares very cheaply. And he really didn't want the Warren Buffett name out there, because he was starting to build up a bit of a reputation at that time for, again, buying very cheap stocks, and kind of didn't want to tip off the competition in that respect. So he actually, rather than buying the stock directly from the farmers and transferring it to his name or his partnership's name, he actually left the shares held in those farmers' names, and those farmers actually gave him power of attorney over the shares, so that he could kind of do whatever he wanted to with those shares when he chose to kind of do something. And he actually ended up paying quite a substantial premium to that initial $30 share price. He ended up paying as high as $100 per share. And at that point, when you turn up to a farmer's house where they bought the stock for $100 way back in the day, they basically considered it, a complete loss and a worthless investment. When someone turns up at your doorstep and offers you $100 per share, to get your money back after all these years, there were a lot of people that kind of, took that offer, and he was again able to accumulate a large ownership position in the investment. And the final part of the story basically is, he has all of these shares which he has power of attorney over that aren't necessarily in his name. He ends up going and meeting with some of the insiders that were also trying to accumulate shares at like $30 per share. He just slaps these physical stock certificates on the desk, and it was kind of a badass early days sort of Warren Buffett story. So that is a second early days investment from Warren Buffett, where he was really working very hard to accumulate a big stake in a quantitatively cheap company in order to generate some really solid returns. Now, the final early days investment that I want to share here this time around is actually from Charlie Munger. So Buffett and Munger were kind of getting to know each other in the 50s and 60s, and fairly quickly Charlie Munger actually flicked the switch from being a lawyer to spending some of his time as a lawyer focusing on investments. He would kind of basically give himself, an hour at the start of the day type thing to work on his own investments, and would basically charge that hour out to himself effectively. And he was willing to make really substantial big bets in his portfolio. I talk about Warren Buffett having a third of partnership assets in Sanborn Map. He's mentioned in interviews that he might be willing to have 50% in his biggest position if he were managing smaller sums of money again. Well, Charlie Munger kind of took that to a whole nother level. Now, the investment example that I want to talk about here is a company called British Columbia Power. Now, British Columbia Power was actually like a merger arbitrage situation that Charlie Munger invested in. The stock was trading at $19 per share, and it was to be acquired by the Canadian government at $22 per share. And Munger viewed that acquisition going through as basically a certainty. He was just completely convinced that there was almost no chance that the deal would fall over, and that if he were to buy shares in this company, he would be able to capture that small spread between $19 and $22. Now, that's not a massive gain, of course, but if you can do it in size, and there's certainty, and that deal goes through in a relatively short space of time, you can generate some really high, risk-adjusted annualized returns. Now, the risk, of course, is if the deal falls over. Often in these situations, the stock might go from that $19, which he was hoping would go to $22. Perhaps it drops to $15 or $12 or whatever it was trading at before, this buyout offer was announced. And in the end, it turned out that the deal did go through, and Charlie was able to make a nice little return from the 19 to the 22. But in terms of moving the needle for him financially, in terms of like his overall partnership and his overall net worth, it actually moved the needle massively for him. And the reason that it did so is because he had 100% of his partnership assets in that investment. It wasn't one of these big 1/3 bets or 50% bets that Buffett talked about. He literally had 100% of the investment partnership in that buyout kind of arbitrage situation. And to get even more extreme in terms of what Charlie Munger did there, he not only had the full partnership assets in it, he also had basically all of his personal money in that same situation as well. And he also borrowed as much money as he was basically allowed to at that time. So he was extremely invested in the situation that he felt clearly very, very confident about. And, that's kind of classic Charlie Munger. When you find a big opportunity, he swings really large at it, particularly if he has a high level of conviction about that investment. So there are a few early Warren Buffett and Charlie Munger investments where they were working with smaller sums of money and trying to generate the highest returns they possibly could. And there's a couple of things that kind of really stand out to me with a lot of these stories. The first one is, in most cases, these investments were just flat out quantitatively cheap. They hadn't yet transitioned to buying the great businesses. I know people are a big fan oftentimes of buying great businesses and holding them for the long term. And I certainly am if those opportunities come up as well. But I am not going to dismiss the 50-cent dollar type opportunities. That is for sure, because as we've seen in these stories, they do have the potential to generate really high returns. Now, the second thing that stands out for me in these stories is the amount of scuttlebutt and legwork that both Warren Buffett and Charlie Munger were putting in. Buffett was flipping through 1,000 pages of Moody's manuals multiple times. He built up a reputation with his friends in the investment business that, basically if Charlie or someone like Sandy Gottesman were to call Warren and, talk him through an investment opportunity that they've stumbled across, Warren would probably already be familiar with it. He'd know the company, he'd have memorized a lot of the financials, and had be able to pretty much give an opinion almost on the spot back to whoever had called him with this opportunity around what he thought about it. So he knew basically every opportunity extremely well. He was turning over a lot of rocks, and when he did find something interesting, he was willing to put in a lot of legwork in terms of acquiring a big enough stake to become active internally in the company if he had to as well. And although I appreciate that's obviously not something that us as small investors can do with, most public companies, we can't often turn activist on them. I think it's a cool thing to kind of keep in mind, and we can always learn things from how important management is in terms of having a lot of these investment opportunities work out well. So that is really all I've got for this one. I do hope you enjoyed it. If you did, please hit like and also subscribe to the channel if you are new here. Like I said at the very start of the video, if you're keen to check out the Spier Podcast episode, first link in the description will take you to the Investing with Tom podcast YouTube channel, and that episode with Spier should be live in the next couple of days. So that is it from me for this one, and I will see you in the next video. Cheers.